Hello and welcome to the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery, and if you're watching tonight, it's likely that you're interested in property and property investing. So as usual, we will be taking your calls and answering your emails on that very subject. We have a great show for you this evening, so make sure that you stay tuned and hopefully we'll be able to assist you if you're beginning or continuing your property investing journey. Now, there are two ways that you can get in on the conversation tonight. You can simply call 1300 30 34 35 and speak with us, or you can send an email at property@skynews.com.au. Let's start the program with the news of the week. And the Reserve Bank Governor Glenn Stevens has hosed down speculation of a rate cut, according to the Property Observer website. Stevens told the AFR that the problem with the economy is a lack of consumer confidence, or animal spirits, as he called it, rather than an issue with the price of money, and emphasised that the importance of providing a steady and predictable monetary policy was high. He pointed to the swinging expectation of economists and experts as to when rates would move and when. We've had a few over the period of time of stability. We've already had at various times some commentators saying that they still think rates may go down a bit. That swung to that they'll go up, and then it swung around a couple of times, Stevens said. ANZ Research latest bulletin notes that Stevens' comments have reinforced their view that the RBA clearly would prefer a substantially lower exchange rate to lower interest rates. And while it hasn't closed off the possibility of a rate cut, at the moment it seems less than convinced that a lower cash rate would assist the recovery. They pointed specifically to his comments that a cut in the cash rate has to remain an open question, and that if the RBA believes it will assist confidence, then it may be on the table for consideration in 2015. Stevens noted that the position of the RBA is to foster confidence by giving people the sense that they can plan ahead. While he noted that not everything is predictable, their aim is to make it as stable as possible. Now, joining me tonight are two of our most capable regulars in the form of Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. And they are here to answer all your property and taxation related questions. So please pick up the phone. We're here to help you. So you can still call us on 1300 30 34 35, or if you would prefer, you can email us. Just tap out a question and send it to property@skynews.com.au. Okay, gentlemen, well, here we are, and we're here at 7 o'clock.
Yeah.
So,
yes, an hour early.
An hour early. So let's hope that our regular viewers decide that they're going to maybe step up and call us.
Check the TV guide.
Absolutely, rather than maybe wait till 8 o'clock and turn on and then we're not there.
We might have all new viewers tonight too. So.
We might indeed. So I think that it's important for us to discuss the first story, and that's really about you know, this complete shift and turnaround that we've seen in the last couple of weeks. I know I sat here at this desk on Tuesday, the first Tuesday in December, and everyone was still waxing lyrical about the next movement would be up next year. Then 2 days later, bang, there we were. What did you think about that, Ben?
Lisa, what we got was unemployment stats,
yes,
and then we got consumer confidence, and both poor numbers.
Yes.
So what we're seeing from that is obviously a challenge around what's happening in terms of what the RBA are actually thinking in the general economy. I mean, they certainly don't want to reduce rates, and it's really important to understand the reason why they don't want to reduce rates is the property market itself. You know, you give consumers the ability to borrow more money, and they naturally will. They'll pay for what they believe is what they want now, you know. So from that point of view, you know, I'm supportive of no more rate changes from a cash rate point of view.
Yeah.
But I'd like to see them do something with business lending. I'd like to see if there's a way in which they can actually look at sort of giving some stimulus to business lending. So not touch the cash rate, but see if there's another mechanism that they can use where they may be rebated. So they approach the lenders and say, we'll give a 50 basis points discount on any business lending that you put out there, and you can come back to us and buy that in a bond or whatever it may be. And that could stimulate what we need, which is basically business confidence to lift so we can get the jobs back online.
And this is the issue of confidence right now, isn't it? I mean, I think we've got, you know, I think consumer confidence is still an issue for them as well. But what do you think, Ian, in relation to, do you think that they've seen some moderation in regard to the performance of the Melbourne and the Sydney property markets. Do you think they've seen that and they're noting that?
I think, look, the things that drive economics, and you know, we all learned it at university when we studied it, supply and demand. You know, no one's questioning those rules, right? But people's demand is driven by confidence is a big thing. So if you haven't got a job, you're not going to go out there and do those things. So as you see unemployment ticking up, we're actually seeing rates or headline rates that are probably worse than during the GFC in this country, which is quite amazing. You really need to dig down to those figures, but you know, even if there's 5% unemployed, there's still 95% employed.
That's right.
And the life goes on and decisions get made. So from a business point of view, I think the biggest thing, I always hear these 0.25% things, and I always, in my own mind, I'm thinking, it really wouldn't make much difference to my thinking. What does make a big difference to business is certainty.
Yeah.
And the more we see rules change, the more we see talk of rules changing, people switch off and go, I'll just wait till it's more certain. Now, we're dealing with business people every day, so when I say that, that's what we're seeing at the coalface.
Yeah, yeah.
So if someone says, look, I could move rates a quarter, would it change it? They go, no, let's just keep the rules the same for a little while. Superannuation, all these things just create uncertainty, constant change.
Well, we're going to talk a bit about some of those rules a bit later. But Ben, you know, I mean, we saw the auctions on the weekend in Sydney. There were just under 1,000 auctions. Fairly strong clearance rate.
100 in Melbourne.
Yeah, and now we're looking at, I think 5 days out from Christmas, another 400 auctions in Sydney. I mean, what are you seeing here? I mean, it's pretty much unprecedented, isn't it?
Look, it is. This is the record number of auctions that have been conducted across Australia. We haven't seen those sort of numbers. Now, if you actually look at the volumes, though, volumes are pretty consistent with what we've seen over the 2013 period. So what we've actually got is a market mechanism. So it's a proven result that auctions get the best results. So if there's pent-up demand and buyer interest, you're best to take it to auction because you'll get emotional results, and those emotional results are what we're seeing now. So I don't think it's been a market like we saw in the 2001 to 2003 you know, mega growth period that we had, where we saw really strong stock on market and they were just being absorbed as quick as they came on. This one's been a little bit more relaxed around, because the first home buyers aren't in the market. They're still not in the market in, you know, they're over in Western Australia, but they're not actually in the Melbourne market or the Sydney market. And for the first time ever, we saw a record number of auctions in Brisbane this weekend. Now, Brisbane has traditionally been a private treaty sale location, and now we're actually seeing them get some confidence around taking that to market. And I think that's probably one of the reasons why Brisbane hasn't seen the same sort of results. Because I'd always said it'd be crazy not to take it to auction. If you've got 3 or 4 bidders, then get the emotional element to it and you get a better result. Obviously, it's more challenging for us as buyer's agent when we're working on the buyer side for our investor clients.
It's that animal instinct.
It is. Animal spirits, as Glenn Stevens says. I guess, you know, a lot can happen between now and February, though, can't it? I mean, you know, the RBA aren't meeting in January. We're also, seasonal factors will come into play, given that we're, you know, just a week and a half out from Christmas, if it's that long. I mean, my time frames have all gone haywire. But you know, it's not that long, and I think that there's quite a bit that can happen between now and then. But I really do agree with Glenn Stevens. We do want that period of stability. We don't really want to shift, and I agree with what you're saying too, Ian. We don't want to shift in the rules and regulations. We just want to keep the status quo.
Correct. I mean, we don't want market interference. Yes. So, you know, we're sitting there, obviously we've got, you know, thousands of investor clients that we're looking after, and this market interference is what's a real challenge for me. It's like, okay, so I'm about to get some confidence up in terms of making some investments or doing decisions, and then, oh, maybe the RBA is going to step in and penalise investor clients with a, you know, 1% increase in interest, or 10 basis points or 20 basis points. But that's the sort of stuff that puts people on the fence.
Yes.
And we want to get them off the fence.
That's
you know,
right.
Joe Hockey's been in Parliament talking about that as well.
Yeah, well, it's also just the complexity of it. So most people hear a change, and there's even talk of it, and when you analyse what they're talking about, it's not that much at all. But it just spooks people to say, well, I don't really know what's going on, therefore I'll do nothing.
That's exactly right.
There's a good argument to say, you know, policies and that should be there to adjust where there's markets aren't working efficiently rather than interfering with it.
Correct. It's an efficient marketplace. Price will find its own. I'd much prefer to see APRA and the RBA come out and say, you know what, not every property is a good investment. And there's people who have actually lost money in property.
Yes.
I mean, we sit here as pro-property advisors and that type of thing, but I'm even concerned with 58% of all current lending being to investors. That says to me that statistically somebody's got to be making wrong decisions. So why don't we go to the media with that story and talk about educating consumers rather than bringing market interference into play just to look after the lowest common denominator.
That's
It
right.
doesn't make sense.
No, it doesn't.
Too much animal spirit.
That's right. Look, let's answer Nicholas's email. We've got a couple of minutes before we actually go. It's our first email of the night, and it's a perfect one for you, Ian. And it's from Ian. It's from Ian, and it's. Could you please explain from Nicholas the difference in tax benefits by owning a property in an SMSF structure versus owning a property in your personal name? I own several properties in my personal name and claim deductions on interest, body corporate levies, rates and taxes, water, etc. against my rental income. Can this also be done if I own the property in an SMSF? Now, if we don't get to finish all of this before we go to a break, we will come back, but let's start with that answer, Ian.
Yeah, well, look, Nicholas is on to a very good point here, which is when you come to you've made the decision to invest in property, you're now faced with a structure choice. So you're talking about should you earn in your own name, a company, a trust, or in a self-managed super fund. And with the advent of superannuation lending, quite some time ago now, so 6 years ago or so, that's an option as well. As I've pointed out in some of the presentations I've done, the differences around taxation are quite significant. So in one situation, if you're in a self-managed super fund that's retired and in pension phase, you're paying no tax on the income and no capital gains tax.
So, Ian, what about the things like the rates and the interest and the, sort of the curtains being replaced and replenished?
All the identical rules. All the identical rules.
Right, they apply.
Yeah, and really the hardest part for people, when you get to over 60 in the fund in pension phase and you say you're not paying tax, people think, oh, can I get a tax deduction for that? And you sort of go like, you're not paying tax. It's a key to switch in your head that makes you stop thinking about that. But zero tax for a super fund that's now paying pensions is pretty generous, right?
Yes.
And to me, it doesn't get any lower than that.
Yeah, no.
And that's one of the issues, the Murray inquiry and all those sort of things. They've got to look at those things. I mean, at the minute, you could have a super fund with $100,000 and pay no tax, and in theory, you could have a super fund with, 10 million and pay no tax. There's equity issues in there to deal with that, but there's limits on how much you can get into super.
Yes.
So there's checks and balances.
There are. And it's like, it's interesting, isn't it, Ben? Because you do have to change that switch in your brain, don't you, when you're looking at SMSF and obviously not paying tax. Yeah.
And I like to call them Smurfs because we talk about this so often, the SMSF every time. But, Nicholas, my message is this. Super is a tax structure. That's effectively what it is. Just like, you've got a tax structure or tax regulations around your own personal name, it's the same sort of thing. I mean, ultimately it was introduced as a means to save, and unfortunately the government of the day didn't trust us in our own ability to save our own money. So it was introduced in '93. It is a tax structure. It's an effective savings vehicle, and obviously recently you've been able to lend in that vehicle, and people have been able to be more sophisticated and take control of their own destiny. And so that was my big thing out of the Murray.
Look, they are really, the Smurfs, as we'll call them, are the perfect thing for our business clients, people who are A-type personalities who want to manage it themselves. People have gone about the costs and all that. The main reason people have these is they want control.
Exactly.
To me, that is the biggest issue. The costs are sensible, but really it's like saying to someone, you should go to a fund because the costs are a little bit lower. It's quite ridiculous because it's not what they want.
No, that's right.
And to me, the only person who'll lose money, and if you've got a self-managed fund, is you. And most of those people say to me, well, I'd like to reserve the right to lose my own money. So I made it, I'll lose it.
That's true, that's true.
Well, I'm actually doing quite well with it, mind you.
Well, let's hope that that's some good suggestions and some good guidance for Nicholas, because it's a good point to make, that you can still make the same claims as
Absolutely.
you can regardless of the structure. Well, we have to take a short break, but stay with us. Tonight, as always, we'll be giving away one of Margaret's books to the question deemed to be the most deserving of the night. And tonight we'll be giving away Margaret's book, How to Achieve Property Success. In this book, Margaret takes the very best from her first 3 books with updated information and new content, resulting in a one-stop shop for property investors. And if you'd like to get your hands on this free copy, then all you need to do is to call us on 1300 3435 or email us at property@skynews.com.au with your question. But make sure you stay watching until the end of the show to see if you're the lucky winner. We're off to that break now, but we'll be right back. Welcome back to the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery, and tonight we're taking your questions and hopefully providing some answers to help you get ahead with your property investing journey. With me this evening is Ian Rodriguez from Bishop Collins and Ben Kinsley from Empower Wealth. And we would love to answer your questions, so please pick up the phone and call us. The number is 1300 30 34 35, or of course you can also email us at property@skynews.com.au. Now, before we went to the break, we were talking about SMRFs or SMSFs, but it was an interesting piece that came out of the Murray Inquiry's recommendations, and what he was saying, he believed that the government should restore the general prohibition which is in place to prevent direct borrowing through self-managed super funds. And I guess this is probably first and foremost your gig, Ian.
Yes.
What did you think about that as a recommendation?
Yeah, well, he's got, it's another inquiry. I mean, we've had Ralph reviews and Henry reviews and Ripoll inquiries, and we're just sometimes over them, quite frankly.
Over-reviewed.
Well, they're all good reviews, and I think they've all come up with good food for thought, but, you know, nothing much comes out of them.
No.
You know, it's very, very slow, painful process. So a little bit of sitting here looking at the Murray one going, okay, righto. When you come down to the actual what he's recommending and what he said, most of it has said they should consider these things. He's actually said super lending's embryonic and it may create risks in the future. And I sort of look at it and say, well, what evidence have you got? Like, what are they looking at? Why do you say that? Now, we had our other email inquiry about saying, I buy a property in my own name, I buy a property in my self-managed fund using lending. They've bought a property, 2 different structures. How does one create a risk to the financial system greater than the risk to the financial system over there? So unless I'm completely missing the point,
yes.
Murray can give me a call, but you know, we really need to understand. I mean, they need to put the case forward other than make these statements.
It's again governing for the lowest knowledge bracket.
Yes.
And it's about protecting consumers and consumer risk. So unfortunately, we have a series of people who are highly educated, highly able to manage their own self-managed super fund, sophisticated almost, although that's a difficult word. You're not meant to use that in financial services unless you earn over $250,000 or something along those lines. So that's my problem with it. My problem with it is that they're people who know how to do it. They know how to use it well, and they know what, you know, they get on with the job. Yet this is going to stop them from doing that. So I'd be saying, OK, if you're going to make a recommendation like that, why don't you then say it's not compulsory for some people? Because some people will then say, I don't want my 9.5% of my wage going in there. I'd actually prefer to manage it myself, and if I want to borrow money and do sensible things with it, I can.
And they're already onto that, partly in the terms of the corpse law that has some pretty poor, but they have a system where sophisticated investors are basically outside of the consumer protection net. You know, it's big boys rules apply. We can make our own decisions. We don't need a nanny state to protect us from evil, you know, sellers of something or other, or loans or whatever.
It's really important for the viewers to understand that, look, they're complex structures. They really are. There is a lot of compliance work, and there's a lot of, you know, you cannot outsource your responsibility when you're looking after them. But there's definitely people out there who can handle that. And then, but again, in any state, we'll just, because obviously with all these inquiries, we do see and hear of horror stories of people who have been taken advantage of, who have been recommending set up a self-managed super fund to buy a block of land in Shepparton, $40,000, just crazy stuff. And I suspect because property is unregulated and we don't have a lot of professional advisors in our space.
They'll still be recommending that same deal outside of super.
Yes, well that's true. But look, and that's, I suppose, you know, the super is the last salvation of the consumer. So I get where they're leading with it. I understand their intentions, but you're sort of casting the net and grabbing everyone. Can you not? Can you sort of look at ways in which you don't?
The piece I don't understand is the risks to the financial system. Like, is it going to cause a collapse of something?
Well, I think if you leverage too hard, you can cook an egg too hard. You know, do you know what I mean? And that's...
But people in the main are not embracing it. It is a sophisticated investor, which is, that has an appetite for it. So, I think it is a little premature.
Well, the actual numbers of funds that have done it, they've got all those numbers. They're actually very, very small numbers.
Yes. They are growing. They are growing, and it's a big. And look, from a property point of view, it's just another, I suppose, mix in the pot, and that's important to understand.
That's right. Okay. Well, look, we'll come back to that topic, no doubt. But to another email now, and this one's from Anil, and he writes, I've heard from many finance professionals that setting your mortgage repayments to a more frequent basis, say weekly instead of monthly, can reduce your loan term by several years. Now that most banks allow you to nominate your everyday transaction and savings accounts as loan offset accounts, does the frequency of the repayment make any difference? And that's from Anil. I'm going to go...
So you start.
Oh, no, well, I'm going to follow up, but I'm interested to hear what you think.
Well, if I've got an offset account and I get interest offset every day, the frequency of which I pay my mortgage doesn't make any technical difference to my savings. If that's 100% full offset, calculated daily, paid monthly. There's a slight...
Well, look, I think it helps. But I think that it does make a difference because, yes, you'll have an offset account and depending on how much, you might have $2 in there, okay? So it actually really does matter.
Or savings.
Absolutely, how often you pay your repayments. Now, what's really interesting here is that when you set up weekly repayments, ordinarily what the bank or the lender is going to do is going to take your repayment, multiply that by 12, and then divide that by 52 to get the weekly repayment. Well, that's not the way to do it.
No.
The way to do it is to take your monthly instalment and divide it by 4, or take your monthly instalment and divide it by 2, and you're going to get the extra payments. That's where you get the benefit from. But the other thing that I think is really important is to take a look at some of these calculators that you can get on any lender's website, and they're everywhere, and they're the extra repayment calculators. And if you plug in those figures, which actually show you those weekly, it just shows you just incredible amounts of savings that you can make just by doing that weekly or fortnightly repayments. But add an extra $10 per fortnight or per week to that, and you'll really see the savings that you
Which is only 2 cups of coffee in our political speak, isn't it?
Well, it is only 2 cups of coffee. But, but I think that a lot of people don't really understand that concept. And I think that, if we're talking about perhaps having rate cuts in February and March next year, which Mr Bill Evans from Westpac is saying, is leading the charge on those 2 rate cuts, I think what would be a great challenge to the people of Australia, particularly with owner-occupier loans, is to not reduce their payments. This is what they should have been doing the whole time that we've been in this downward cycle since November 2011. But say, for instance, they haven't, and they've really been enjoying the fruits of lower rates, then now would be the absolute time for them to say, right, if 2 rate cuts come in the first quarter of this year, of this coming calendar year, then I'm not going to reduce my repayment, and that's where it's going to really benefit them. What do you think, Ben?
Look, it is, Lisa, the only thing you're going to have the government saying the other. They want you actually out there spending the money. Joe Hockey wants you to spend for the economy.
Yes.
So
I want you to spend, I want you to save.
Each household's going to have to make that decision, but it's great financial advice.
Yeah,
it really is great financial
advice. That's exactly right.
There are competing policies at play. So basically, one policy wants us to save more, one wants us to spend more.
Exactly.
So no wonder we're confused.
We are confused. Well, there's still plenty of time left. And if you have a question for the panel this evening, all you need to do is call us on 1300 30 34 35 or email us at property@skynews.com.au. We're off for a break, but don't go away. We'll be right back. Thanks for staying with us. You're watching the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery, and we've been getting through some great questions tonight and hopefully offering a few insights into how you can become a more informed property purchaser, seller or investor. If you call or email tonight, you'll be speaking with Mr. Ian Rodriguez from Bishop Collins and Mr. Ben Kingsley from Empower Wealth. So all you need to do is pick up the phone and call 1330 3435 or email us at property@skynews.com.au. And don't forget, you can also have a chance to win a copy of Margaret's book if you do. So please pick up the phone. I know that it's Christmas time and I know that it's also a new time slot for our property edition, but you know, if you do pick up the phone, we'd love to answer your question. So here we are. I think what we might do, given we have no callers, is go straight to another email. And we've got our next one, and it's from Miriam. And she writes, when including property deductions, example, phone or internet, in your tax return, must you allocate a proportion of the deduction against each property that you own? Or can you just pick one property to allocate the whole deduction against? Currently, we do the former, but it would become a lot more work if we had many properties. And that's from Miriam. I'm going to go straight to you, Ian, on this one.
Yeah, the actual rules about keeping tax records for use of telephones and all that, if you actually look at what they say, it'd have to be the most boring, annoying thing you could do with your life. But the tax man, tax woman, as Margaret will correct me on, requires you to substantiate your use in a diary for a reflective period of time and record that. So the realities are, I don't believe Marion needs to record every call forever, just a usage pattern. Should check with your account on the exact details of how long that'll be for and keeping that. Then she's raised a good question, because if you've got multiple properties or multiple businesses, do you have to record a bit about over all of them? And there's actually a different section in the tax return for each property.
Yes.
So each property you own is a whole another schedule. So there's 1.9 million property investors from the 2012 tax returns, and they're all required to do this very productive economic outcome. So it's just one of those things. You're just going to have to do it.
Yes.
And record it once and then hopefully forget about it. Like car logbooks are the same. It's once every 5 years for a 12-week period. Our advice to clients is, look, get the rules, follow the law. Once you've done it, then you don't have to worry about it again for a long time.
That's right. We've had to follow the law, all of us sitting around this table, haven't we?
Yes.
Ben, anything to add to that?
No, I think you've answered it well. I don't think there's any more. Any time you're working on your investment properties or travelling to them or whatever, make a record of it. There's obviously a cost associated with that, and that's claimable. And
it all gets very, very arbitrary too, because a lot of people, computers nowadays, I mean, you're using them for business and private things all the time.
Yes, that's right.
So, look, there is some guidance from the taxman about how to best keep those records. If you're looking for entertainment, read up how you're meant to maintain laundry expenses. Even that's more entertaining.
Is it?
So it is, right? So a lot of these rules have been there for a long, long time. And, we do get a chuckle out of that. Us tax people, takes a bit to entertain us, but that sort of stuff.
Yes, but I'm sure you have a lot of fun with tax law.
Oh, we do.
Well, from Miriam we go to Marion, and that's our next email, and it's from Marion. And she writes, I'm looking to get a valuation done on my property and was wondering how to get or find a valuer. Do I just pick one from Google search? How do I know which ones to trust? A good question, Ben, isn't it?
Great question from Marion. So, Marion, there's a couple of things here. If you've actually got a professional package with one of your lenders, and the property's obviously got a loan against that, as part of the package fee you can potentially get a valuation done. So if you've had an evaluation done in the last 12 months, you can actually get a valuation done through that lender if you're looking to, say, release equity or just basically get a valuation done. Now, what I would say to most people is, if you are looking to outsource that valuation to a professional licensed valuer, don't Google it. Please don't Google it. You need to be talking to a valuer who has specialisation in that local market. There's nothing more frustrating than sending a valuer from a big company into a marketplace that they're not valuing every day. They won't have good comps, and comps by I mean comparable comparable sales of the local properties and the local market, and they won't have a good understanding of what that is. So my advice to you, Marion, is to basically speak to them, say, do you do this area all the time if you're going to outsource it, or go to your lender or your mortgage broker and get them to also organise it if you've got that under ProPack.
Yeah, I think one of the key things too I've always seen is the purpose of the valuation. So a lot of people rely on the bank valuation as being an indication of what the property's worth.
Good point.
When in fact that valuation's been done for the bank for a purpose, about security. And I think, to me, I think you need to get values like you've said, but very clear on the purpose. I need to understand the current market value to decide whether to sell or retain the property. If you're relying on the bank value, you may be making the wrong decision.
Or lock in the 6-year rule as well.
Yeah.
That's another good point.
And, you know, agents probably good ones, not for valuations, but to give you a better picture of the market. But, you know, again, you can range from over-optimistic to, you know...
And let's be honest, that's an appraisal. Would the ATO accept that? Would they accept an appraisal, or...?
Oh, it depends on what the purpose is. Okay. But for many things, for state revenue purposes and for capital gains tax, they require valuations.
Sworn valuation.
For different purposes. And there are some situations where an appraisal is good enough. But if you want good advice about it, you need to know the purpose the value is doing it for is very important.
It's interesting, isn't it? Because most of us really only deal with valuers through the process of buying the property, and we don't have that direct contact with them. So it's it's very much a foreign.
Well, you probably even
experience.
have no legal rights if you've relied on a bank valuation. It's for the bank.
Yeah.
If a valuer gave you a valuation that was profoundly wrong or negligent, you'd have some rights against them, I suppose, right? But
and normally why some people do it is separation and divorce. So they're actually going to get their own valuations and comparing the two and then sort of coming up with a settlement.
With a number.
Yeah. So it's a good point.
It is a good point. Well, hopefully that will help Marion. Now, we're going to go to another email, given that we still don't have any calls. But the next one's a long one, so bear with me. And it's from Travis, and he's from Perth. And he writes... I've established $300,000 equity in my first home, and I'm looking to purchase my first investment property. I'd like to get your thoughts on purchasing house and land packages for investment purposes. I'm looking at purchasing in a new estate being built within an already established suburb on a new, now vacant high school site. I have a concern that the cost to cover the mortgage, even at instalments while the home is being built, might outweigh the benefit of any growth. I have had great success with my first home, also a house and land package with a 40% growth in 2 years after building in 2010. Okay, so this is a really interesting question from Travis. You know, obviously he's looking to buy, you know, well, around where he's living now, house and land package. For his, the time that he bought his first one as his first home, it's worked really well for him. So he thinks he wants to take another bite of the cherry. Ben, I'm going to go straight to you on this.
Yeah, Lisa, I'm glad you did. This is all about location, location, location. So most house and land packages are built out in the established areas, in new greenfield areas. So when we're in greenfield areas, that's usually the lower level of affordability. Now, when you're going out to house and land packages in that area, you need to do your homework, because where is that capital growth going to come from? If people in that area can't afford to push the values any higher, you're not going to get that capital growth. Now, in your question, Travis, what you actually talked about was a high school, which has been obviously carved up and subdivided in an established area. So this may be an opportunity for you to actually pick up a well-selected location, and then building something like this. I would say, and I need to know what the purchase price is to give you, you know, sort of personal advice, but in reality, what I'd be saying, if you can keep the overall land value and the construction cost to within the median value price range in that location, you're going to be well served, where you're not going to get what I would call a valuation or go too hard for the established benchmark pricing, which basically means in layman's speak, is you're trying to make sure that if there's any correction in value, you don't have a downside risk. You were talking about that during the construction phase, that you didn't see any growth happening. Well, that's how you do it. You basically buy the cheapest form of land and build the same type of construction on that land, say a 4-bedroom, 2-bathroom house, but you keep it at the lower end of the median values, and usually you insulate yourself from any type of downward pressure and give yourself some upside.
Interesting. I think we're probably going to have some differing views here. What do you think, Ian?
I actually like what Ben said, but yeah, that was pretty good.
I'm not big on house and land. I should be saying that. I'm not big on it, but in the right areas.
And I think that's right. Where you've got house land, typically it's greenfield, REITs of oversupply, but Travis just made the point here.
It's a little different, isn't it?
Yeah, this is a bit different. And so it may well be, you can't just say because it's house land, it may well be in a small enclave. You know, it's very
well, we don't know how many dwelling
units.
No, we don't have many.
The point that Travis made, though, he actually said in his email 40% growth in 2 years on his first one.
Yeah.
So I don't know what the story was with that, but no one's going to complain about that.
No, I wouldn't. He's very happy about that.
He's obviously bought well. So maybe, you know, it was the first house and land and they were letting him go really cheap to get it going. So maybe he bought well and that's where the increase has gone and maybe there's no more coming. We don't know the answers. Too much to work out.
It is too much to work out. Well, unbelievably, and I'm quite euphoric. We have a caller and it's Hitch from Melbourne. Hitch, how can we help you this evening?
Oh, good evening, panel.
Good evening.
I had a property in Mornington for the last 10 years. I'll make a substantial capital gain. I was wondering, a friend of mine told me that you could put in $30,000 from the capital gain into your superannuation. I just wonder if that's correct. If you could please answer
Okay, now just don't go anywhere just in case Ian has some questions for you, Hitch. Do you need to know any more information on that, Ian?
No, I'm probably right with that.
Okay, let's see what Ian thinks, yes.
Yeah, thanks, Hitch. So, look, that issue, so obviously this capital gain's possibly been made in Hitch's personal name as an investor. Depending on your circumstances, you can make super contributions. And currently, I think in the current financial year we're in, I think that's correct. What he's told me is $30,000 as a tax deduction. Last year it was $25,000. I think it's been indexed up. And there's situations where you might be able to do a little bit more, right? But without getting into the complexities, you need to talk to your accountant about what your limit actually is.
Right.
But $30,000 is a general limit. The issue you have is a bigger one, which is if you're an employee and you're receiving wages and your employer's making contributions, you need to salary package and you need to organise that at the start of the financial year sort of rather than at the very end. So you need to be able to take your salary down and package it into super. If you're not an employee, so you're not getting like what used to be called a group certificate, but is now called payment summary and all that, but if you're not receiving wages, then you can make your own contribution. So if you're just an investor with no other income, you can make that contribution yourself in your own name.
Right.
Basic answer is Hitch is on the right track with this. Superannuation contributions are a great way to reduce the capital gains tax, but you need to get advice from your accountant early and up front to understand the rules, not sort of on the 29th of June.
Right.
Okay, where you're starting to think about it.
It's tax planning. It's good old-fashioned tax planning.
It needs to be done before you sell it, preferably.
Right.
Work out what the gain's going to be, what are the ways to minimise it. There are lots of ways to do that.
Right.
Timing's everything with capital gains. I've said before, easiest tax in the country to not pay, don't sell.
That's right. Okay, that's great. Well, look, we do need to go to a break, and the questions and the conversation have been great so far this evening, and there is still time for you to join in. So send us a question at property@skynews.com.au or call us on 1300 30 34 35, just like Hitch did. It's time for another short break. We'll be back in just a moment. Welcome back to Your Money, Your Call. I'm Lisa Montgomery, and with me in the studio tonight is Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. And there is still some time for you to call and ask us any question about property or finance or tax, and you can do that by dialing 1300 30 34 35 or email us at property@skynews.com.au. And remember, you can get a copy of Margaret's book, and it is up for grabs. Now we have another caller, and it's Tim, and he's from Sydney. Tim, how can we help you this evening?
Oh, hi. I'm just curious about whether I've missed the boat with regard to investing in property. My wife and I are both in our late 50s. We have a lot of equity in our home. We have, I have a business that's going very well. My wife will retire in a couple of years with good super. And I'm getting conflicting advice as to what to do.
And And so currently, Tim, have you other investments in other asset classes?
I have some shares.
Right.
But not really. I mean, my wife has a lot in super.
Okay.
Yeah.
All right. Okay. Well, let's go to the panel about the subject of age, and I think it's a good one, isn't it? Because you know, Tim's. I don't think you're ever too old to invest in property, quite frankly. That's just my personal view, and certainly not advice. But Ben, what do you think?
I'm with you, Lisa, and Tim. I would be saying the same sort of things. There's no missing the boat. I mean, in different marketplaces, we're in different cycles. If you actually have a look at what the media is covering right now, it's mainly Sydney and Melbourne. But Brisbane still has some uplift in its cycle. There are other parts of Queensland that are also potentially looking to be in an upward cycle as well. And I think if we talk about age, what I like to think about with age is we know that the forecasts are that we're going to live longer. So if we're talking about living to 80, 90, and by 2050 they're talking about females living to 98 and males living to 97. So from that point of view, we're a long time, you know, sort of alive, and we've got to start to look to invest. So I'm the same. I've advised clients who are in their late 50s to look at investments. My biggest tip for you is don't risk the farm. You know, don't take aggressive moves to try and accelerate the outcome like some people do. Don't be encouraged by all these fancy hype merchants and spruikers who are out there who are promising quick fixes and quick returns. Property is a long-term investment, but we can get gains over time, and at late 50s, that's not old. You know, you're still a spring chicken. So from my point of view, definitely look at it, sit down with a qualified property investment advisor, go through your numbers, understand exactly whilst you're looking at property and why you prefer property as a possible option for you, and then, you know, do the numbers and then make an informed decision.
A good suggestion there. Ian, what do you think?
Look, Tim, the issue Tim raises is such a good one. I mean, so age is one thing, but your own approach to what do you want to achieve. Has he actually got enough money to retire now and meet his lifestyle goals?
Yes.
My view, if someone's got, yeah, we see this all the time, very different plans and needs for the future. If someone's got not enough money to retire, you either need to reduce your lifestyle expectations in retirement or do some more investing. Versus some people have retired, have got millions of dollars sitting in a term deposit and won't sleep at night if they've got a property or a share or a debt with the bank. So it becomes a very personal decision, and unfortunately, yeah, Tim, that's a decision you need to make, getting good advice. And, you know, your accountant or financial planner is the best place to get that. But you need to make sure that advice is personal and you're happy with it, because anything from doing nothing to going sort of, you know, full into property investment could actually be the right advice.
Yes.
But it all depends on what Tim needs and what he's comfortable with. And I guess the law tries to deal with it by saying it's inappropriate, but without knowing those things about Tim, what's appropriate and inappropriate for him can be very different.
That's right.
And you know, the other one that makes it even more complicated, Tim said his wife there as well, we sit in situations where, you know, Dad says, oh, I'd love to do this, and Mum goes, I don't want to do any of that.
That's right. And so they really need to be in concert. And Tim, you know, I think one thing that Ben said is absolutely correct here. Don't bet the farm. Make sure that you keep within the limits of the strategy and the structure that you set for yourself. That's very important. You have to have a strategy and you need to stick to that, and surround yourself with the experts that are going to go on this journey with you, because this journey may be a short one or it might be a long one, but you need to have the people who are going to give you the good, strong advice that you need for this time in your life. Okay, we've got another caller, and that's Anna. Anna, how can we help you? You're from Sydney also.
Yes, I am. I wanted to ask a question about dual key properties and what the panel thought about them, and specifically in areas like Ipswich. I wanted to know if you think it's a good buy, and as an investment, will it grow in value? I'm sort of thinking, looking at sort of 3-bedroom plus 1-bedroom dual key properties in the Ipswich area.
Okay, thank you very much for calling, Anna. I'm going to go straight to Ben on this. What do you think, Ben?
Thanks for the call, Anna. Dual keys are really sold on the yield that they deliver, but they do have limitations. I mean, it's the same sort of thing as saying, I want to buy a house and put a granny flat on the back. The next buyer that comes along has got to understand exactly what they're getting. So it's really important to understand the limitations or the cons of doing such a thing. From a cash flow point of view, the numbers stack up. In terms of Ipswich, I'm still a little bit on the fence on Ipswich. It's not my preferred location at the moment. These type of dual key developments occur in these areas because unfortunately, the lower socio-demographic that's in that particular location. So, for me, there's more research that I would need to do, and it's a pass for me normally on these dual keys. So that's my advice.
Anything very quickly to add to that, Ian?
No, it depends again. Once again, I think Ben's covered it. Dual key can be a good thing. It depends on the region you're in.
It does.
So I don't really think you say dual key's good or bad. It's where it is.
That's right. OK, we're going to go to another caller. All the callers at the end of the show. Ken, you're from Melbourne, and your topic is moving into an investment property. How can we help you?
Yeah, look, I have a property that I actually own in the southeast suburbs of Melbourne, and the investment properties in the southeast suburbs as well. But I want to sell my home and move into the investment property and use the money for a bit of travelling.
Right, OK. So how long have you had this investment property for?
About 6 years.
Right, and you've been, and is this your only investment property you have?
Yes.
OK, and you're going to sell your owner-occupier property?
Yeah, I just want to know what legal or, you know, what tax things I'm up for, or whether it's possible I can actually move into it.
Well, it's perfect because we have Ian tonight, and he's going to quickly answer this question for you.
Yeah, so Ken, look, moving into an investment property is generally no problem. It's okay. One of the things that people really need to understand is if your residential property is owned by your self-managed super fund, and you would have had good advice by this stage, but that is an absolute no-no. Can't be done. Commercial property, totally different story, but you don't live in those. But residential property, even renting it to an associate or a relative, all those things. So people need to understand the limitations of those rules. The big issue for Ken's going to be about the debt, where the debt ends up, and making sure his tax situation, because he's moved in, it's no longer a tax-deductible debt.
Yes.
So he might want to pay that off or redraw or offset or whatever the case may be. And also capital gains tax. So he's now got a situation where the taxable asset's going to become a principal place of residence. He can move out again and use the 6-year rule. So I think, Ken, good chance to get in and have a chat to your accountant and just plan out what your longer-term plan is.
Yes.
You may be able to get rid of a lot of the capital gains tax over a period of time by this becoming your principal place of residence.
Well, that was a good suggestions, I think, for Ken. And I'd love for you to answer this, but we have to go, unfortunately. And that's all we have time for this evening, which brings us to the winner of Margaret's book, How to Achieve Property Success. And I think we should give it to Tim.
I agree.
And Tim was calling about buying investment property at the age of 58 or late 50s, and I think that's a great idea. So if you would like to email me at lisa.montgomery@tpg.com.au. That's lisa.montgomery@tpg.com.au, and I'll arrange for that book to be sent to you, Tim. Thank you so much for your questions this evening, and thanks also to my wonderful guests, Ian Rodriguez from Bishop Collins and Ben Kingsley from Empower Wealth. And if you are so inclined, you can follow me on Twitter at Lisa Knows Money, which is all one word. Michael Tees will be in the chair next week, so make sure you tune in to see him and the rest of the panel. And can I also take this opportunity to wish you and yours a happy and safe, a very safe holiday season. I'm Lisa Montgomery, and I'll see you in the new year.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.